Have you ever found yourself, eyeing a familiar brand, maybe one you've ordered from 100 times, and just wondered what's really driving their success behind the scenes? We've all had a Domino's pizza night, right? But how exactly does a global giant like them navigate today's market, this fast-paced, value-driven market, especially with the latest numbers just out?
It's a great question
Yeah.
because for a company that big, every single move is, well, it's incredibly strategic. And in today's economic climate, those strategies are really under the microscope. It makes their latest results even more interesting to look at.
Right. And that's really our mission today on the deep dive. We want to slice through the numbers, the commentary from the executives, everything from Domino's Pizza's second quarter 2025 results. We're going to try and uncover what's, truly driving their performance, what their playbook looks like, and, well, what it all means for the company going forward.
Yeah, and we've pulled directly from the official sources, the Q2 2025 financial results press release, the earnings call transcript, and also their detailed 10Q filing. So ready for maybe some surprising facts, maybe some aha moments that might change how you think about your next pizza order.
Okay, let's start maybe with a high-level health check. Domino's reported some, well, really quite strong Q2 2025 performance. We're looking at global retail sales growth. This is excluding foreign currency impact of 5.6%. That's a pretty solid jump.
It is, yeah. And what's striking is kind of the breadth of that growth. So U.S. same-store sales, it's revenue from stores open at least a year. Give you that good comparison, they were up 3.4%. And then internationally, same thing, same-store sales up 2.4%, again, including currency effects. And on top of that, they expanded quite a bit, added 178 new stores globally, 30 in the U.S., but 148 internationally. That's significant.
And it looks like the profits are following that growth. Income from operations jumped, 14.8% or 14.9% if you strip out minor currency impacts. So the top line is clearly growing and the bottom line's benefiting. But how are they actually managing this? Because you hear all the time it's a challenging market out there.
Well, the CEO, Russell Weiner, he credited their strong Q2 results directly to meaningful market share gains, specifically in the U.S. pizza QSR category. QSR, of course, quick service restaurant. And he really believes their hungry for more strategic pillars are delivering. His words were more sales, more stores, and more profits. So it's not just good numbers. It sounds like there's a cohesive strategy really working here.
Okay, that hungry for more playbook. That sounds like the engine. Let's dig into that a bit, starting with most delicious food, maybe, because that's where the Parmesan stuffed crust pizza comes in. Launched late Q1, and Wiener called it one of the biggest new menu items in our history. That's a big claim.
It is a big claim. And what's really insightful isn't just the launch, but the impact it had right away and how customers reacted. They said it's delivering incremental new customers, achieving a high mix, meaning lots of people are ordering it. But maybe more importantly, the customer feedback, the praise for it, has been significantly higher than any of our recent product launches. Something, right? They hit a nerve.
Right. Tapped into some unmet demand or something. And it's not just a flash in the pan like a limited time offer. They're saying it's strategic. It's meant to be a market share catalyst because it addresses a reason people might have gone somewhere else for pizza before. And it's permanent, like their New York-style pizza, designed to stick around and keep pulling people in. That seems, well, crucial for long-term growth.
Yeah, that long-term view, focusing on menu items that last, that's key. And it actually connects perfectly to the next pillar, renowned value, which is kind of their multi-pronged approach to getting and keeping customers. Like, they finished the national rollout with DoorDash, the big delivery aggregator. By the end of Q2, that's on top of launching with Uber Eats earlier.
Yeah.
And DoorDash, it's about twice as big as Uber for pizza sales. So that's a really significant partnership.
Exactly. And they expect those DoorDash sales to build up more in the second half of the year. With marketing money coming from both sides, they see it as a meaningful driver for their U.S. comparable store sales. And beyond aggregators, their loyalty program, Domino's Rewards, the redesigned one, that's also helping comps, especially carryout.
Oh yeah, that carryout business is really performing well. Impressive resilience there. It saw a 5.8% comp increase. And get this, they said it was their highest quarter of average carryout orders of all time. All time. The loyalty program itself is seen as a multi-year sales driver. Active users keep growing. I mean, it makes you wonder, are we all just getting lazier? Or have they really nailed convenience? Either way, it's working.
Yeah.
And then there's the best deal ever promotion running through early August. That's part of the value strategy too, giving customers deals in this sort of pressured economic environment.
Hmm. And none of this works without the next pillar, right? Enhanced by best-in-class franchisees. The franchisees are the secret sauce, as they put it, like that stuffed crust launch. They connect its success directly to training investments and the operational excellence of those local owners.
Right, and this also shows up in how they manage ownership. They recently refranchised, basically sold, 36 company-owned stores in Maryland, sold them to Suhal Unal, an operator who's been with Domino's for like over 2 decades. They said this isn't some big departure in strategy. It's more about strengthening the brand long-term by putting stores in the hands of experienced, dedicated owners who really get the local business.
That structure does seem powerful, like a feedback loop. They believe these best-in-class franchise economics, plus having the largest advertising budget and a robust supply chain, those are fundamental advantages. They drive long-term value. And you mentioned the average franchisee has 9 stores, leading to pretty nice cash flow. Sounds like a really intertwined system.
Absolutely, it's a powerful model.
Okay.
Okay, so let's maybe crunch some numbers, dive a bit deeper into the financials. Total revenues were up 4.3% in Q2. So what drove that? Mostly higher supply chain revenues, more U.S. franchise royalties and fees, and higher U.S. franchise advertising revenues. Points to a healthy core business.
Okay, breaking down that supply chain piece, the revenue growth came from a 4.8% hike in the food basket price to stores, which is like a $45 million impact in Q2, plus obviously just higher order volumes overall. Though they mentioned some offsets from product mix shifts and changes in their equipment business. And those franchise royalties and ad revenues, those tie directly back to the same-store sales growth and adding new stores, right?
Yep.
Especially with the ad rate going back to the standard 6.0%.
That's exactly. Now, the margin story, also interesting. Consolidated gross margin actually improved by zero point 0.5 percentage points up to 40.3%. Part of that is just how franchise revenues work, right? No cost of sales there, so it boosts the average.
Right.
However, for the stores Domino's owns itself, the U.S. company-owned ones, their gross margin decreased by 2.0 percentage points, mainly due to higher insurance costs and that higher food basket pricing. So a bit of a mixed picture there.
Oh, okay. But then on the supply chain side, the gross margin increased by 0.5%, driven by what they called procurement productivity. Sounds like good purchasing. They have a fantastic procurement team, apparently. They did say those big gains might slow down over time, but the benefits are now kind of locked in the base. So yeah, some margin pressure in one area, but offset by efficiency elsewhere.
Indeed. And if you connect this back to overall profitability, income from operations jumped that 14.8%, about $28.9 million higher. Why? Well, those higher U.S. franchise royalties, the supply chain margin growth we just talked about, and lower G&A expenses, general and administrative. The lower G&A was mostly because their big worldwide rally happened in Q2 2024, so those costs didn't repeat this year. Plus, there was that $3.9 million pre-tax gain from selling the Maryland stores.
Okay, now here's where it gets maybe a bit tricky. Despite all that positive operational stuff, net income actually went down 7.7%, and diluted EPS dropped 5.5% in Q2. That feels counterintuitive. What's going on there, beyond the headlines?
Yeah, this is exactly why we do these deep dives, right? Go beyond the operational wins. Because while the core business performance was great, two big non-operational things really hit the bottom line. The main one was a big swing, a $27.4 million unfavorable change in their investment in DPC-Ltd. That's their master franchisee for places like Japan and Australia. It reflects losses, realized and unrealized. And then second, their effective tax rate jumped quite a bit from 15% last year to 22.1% this Q2, mostly due to changes in tax benefits from stock compensation. So it really highlights how these external financial adjustments can overshadow strong core performance, gives you a more nuanced view of profit.
Right, I see. So given those hits, what does it mean for their cash flow? And how are they allocating capital?
Well, actually, their operating cash flow looked really strong, up $92.7 million for the first half of the year, mostly driven by favorable timing on payments, accounts payable receivable, and some advertising fund changes. This helped boost their free cash flow significantly, up 43.9%, hitting $331.7 million for the first 2 quarters. Lower capital spending helped too. These are all, really positive signs about their financial health and their ability to generate cash.
And that confidence seems reflected in shareholder returns. They're still paying dividends, right?
Yeah. Continuing the quarterly dividend, $1.74 per share declared for Q3, and they've been pretty active buying back shares, $150 million worth just in Q2. And they still have over $600 million left on their authorization, so $614.3 million.
Okay. And debt. Any concerns there?
Well, they have about $4.98 billion in long-term debt. They do have some notes coming due in October 2025 that they expect to refinance the 2018 and 2015 series, but they mentioned their holdco leverage ratio is below 5.0x, which actually helps keep other debt classified as long-term. So it seems like a manageable debt structure, especially given their business model. They seem to have a solid handle on it.
Okay, let's zoom out a bit. Talk about the bigger picture. Because the QSR pizza category itself, it's actually pretty flat right now. They said roughly flat through the first half of the year, and maybe even negative traffic if you factor in pricing. Definitely a pressured macro environment for a lot of players.
Which really brings up that key question. How is Domino's doing so well when the market overall is just kind of treading water?
Yeah.
They describe themselves as playing on offense. Their U.S. retail sales grew 5.1% in this flat market. They're leveraging those unique strengths we talked about, the franchise economics, the big ad budget, the supply chain advantages. So what's a headwind for others seems to be a tailwind for Domino's, letting them grab market share.
And the CEO sounds pretty confident they can keep doing that, gaining about 1 share point a year historically. He said even though they have a quarter of the market, there's a lot more for us to gain. They feel like they're built to do this. It does sound like a structural advantage.
Absolutely. And if you look at the multi-year growth drivers, product innovation is huge. Things like stuffed crust, New York style before it. They stress these are not LTOs,
Yeah.
not limited time offers. They're seen as major pieces of share within the marketplace that we can go after for a long time. They launch things that stick around for a while. It suggests a really strategic long-term approach to the menu, building lasting value, not just temporary buzz.
That's a really key distinction, isn't it? Building the core offering.
Yeah.
And their digital side, the loyalty programs, those are also seen as multi-year drivers. Plus, that new e-commerce program is rolling out okay. No disruption to their already huge 85% digital sales mix. They really are a digital-first company.
Definitely. And internationally, the strategy seems to be translating too. Markets like India, Canada, Mexico, they're adopting that hungry for more approach successfully. Like in India, they launched a volcano pizza. They're pushing 20-minute delivery. They even got rid of delivery fees to drive volume. Shows how they adapt the core ideas locally.
What about store growth internationally? The outlook there?
Yeah, full-year global net store growth is expected to be similar to 2024. There are some challenges, though, specifically with DPE, that's Domino's Pizza Enterprises, the big master franchisee mainly in Asia-Pacific, including Japan. They had some expected store closures in Q1. Their opening plan there is still seen as a risk tied to unit economics and sales performance. But outside of DPE, they said development is tracking to plan. So, a bit mixed internationally, but mostly on track.
Okay. And looking even further out, are they thinking about expanding the menu beyond pizza?
Sounds like they're prepared for it, yeah. They mentioned potentially adding categories like chicken down the line, their current store design, their tech system, Domos. They said it could support additional cooking platforms if, consumer demand really calls for it. It shows they're thinking ahead, building a flexible platform to adapt.
Okay, so wrapping this up, you've really just seen how Domino's is strategically navigating what sounds like a pretty tough QSR environment. They're leaning hard on their core strengths, innovative products like the stuffed crust, diverse value offers with loyalty and aggregators, and that really robust franchise system, their secret sauce. They're not just, surviving. They seem to be playing offense, actively taking market share.
And what's really fascinating, I think, is that contrast. If Domino's can pull off this kind of growth and profitability by going on offense during economic headwinds in a flat market, what does that signal? What does it say about the long-term competitive landscape for other QSR players who seem to be just, treading water?
Yeah, it makes you wonder, could Domino's unique setup, that franchise-centric arsenal, the supply chain, the ad budget, the unit economics, could it fundamentally reshape who leads the whole restaurant industry, especially when or if conditions get better? It's definitely a provocative thought. What do these advantages mean for the broader market long term? Something for you to chew on.